Society is still looking for anybody who wants to do new classes, one-time presentations, maybe a shared interest group, or seminars like we're doing here. So if you have anything you want to teach about or just anything you're passionate about that you want to talk about, definitely consider doing that. I'll leave our disclosure up for a moment. And moving on. First, we'll start with recapping what we talked about last time. And if you missed last class, most of what we talked about was recapping everything that we had talked about in terms of portfolio building and sort of looking at your assets and being able to understand what they're doing, how well they're doing it, and their qualities, just really all that sort of analysis and construction stuff. We started going back over all of that so that we could make sure that we understood where we were, and then we can move on towards portfolio monitoring and checking up on everything that you've done previously. So we went over investment objectives. So we talked about all the way from the most conservative or current time-based stuff like current income, looking to generate yield or dividends today, going all the way up to balanced growth and income, stuff where you're starting to get a little bit more aggressive and you're looking for some capital appreciation versus just the income. Getting all the way to growth and maximum growth, things that young clients would want to see, or if you just got monies that you're not really particularly needing at all, you can allocate in these sorts of ways, and how those change, what kind of investments that you might be in. We also talked about our risk tolerance, which, while it is extremely similar to your objective and can make a difference in what your objective ends up being, it really is, in my opinion, more of a, it's kind of like a more emotionally driven thing and something that is more particular to every person. Because we might have numerically the same solution for a bunch of different clients, but we might have tolerance differences, we might have feelings differences, we just might have a difference in reaction to the different kinds of movements that can happen in the stock market. You might have somebody that can be realistically in an 80-20 portfolio or a 70-30 or something else really aggressive, and it's going to be just fine for them. And even if they lost 50%, they would still fulfill all of their goals, but they may not be interested in that proposition of that loss. So you could have somebody who wants growth, but might be a moderate or a moderately conservative person, to where they don't need the income, but they don't want to suffer aggressive losses. So both of these things go together to really give you what your risk profile should be in your investments overall and for each portfolio. So going all the way from conservative down to speculative, going from minimal fluctuations to the highest level of risk or reward. And obviously we went back over some of the types of risk. So when you're considering what your risk tolerance is, you kind of are thinking about how all of these are playing into that overall picture. Now, for the most part, when we're talking about risk tolerance, what we're really talking about is our systematic risk, and most specifically our market risk. That's really what we think of when we generally think of risk, because we're thinking of the risk of an asset moving upwards or moving downwards and how that might change the value of our portfolio. Obviously, all of these things are important, but again, these are things that are managed or nearly eliminated by most of the work that we did previously. We went back over our lateral and vertical integration concepts and how we go through each stage in order to manage and diversify away those risks that we talked about previously. So when we're talking about our stage one, we might talk about our current income needs. We might look at things that we want to have with very minimal market risk, that things that would have a very low risk profile, things that don't move a lot, stuff that might generate some income but won't necessarily be moving up and down with the market or with interest rates. Moving to stage two, when we're looking at our longer term debt instruments, balanced index funds, things that are having some volatility but not enough to get you nervous, not enough to make you want to move around too much, stuff that you're willing to sit out through the market, you're willing to sit through the volatility up and down, but something that's not going to give you 30 to 40 to 50% losses in a bad year. And then obviously we move all the way to our stage three, which is our long-term looking. We're looking far off into the future, looking into that horizon, and we're willing to suffer lots of volatility, lots of risk, lots of downturns, so that hopefully we can see a lot more benefit on the upside. We talked again over the portfolio construction theory concepts, the types of risk, the lateral integration stuff, the 3 stages and the diversification pyramid, which are just fancy names for all the stuff that we've done, which is picking the proper assets for each objective and time frames, and giving ourselves lots of different exposure so that we're not concentrated in any particular area. And we put those concepts to the test, and we made a sample balanced portfolio. We also learned how to use modern portfolio theory concepts, things that were developed by, I believe his name was Harry Markowitz, and stuff like beta and alpha and R squared, these different things that we can use to evaluate portfolios and investments and see if they're matching all those things that we talked about previously. Because we might be looking at our market risk, and we might be thinking that we want to see maybe 60% of what's happening in the market. We want to feel about 60% of that volatility. But if our portfolio comes out with a beta of 1.2, we're not on the right track, and we need to make some changes. So we looked at these different things, and also our risk and reward analyses like standard deviation, mean return, and Sharpe ratio, and how we were able to apply those to our portfolios and to our investments in order to evaluate whether they're actually following our needs. And we also learned about how to assess the risk of some of our bond holdings in funds and portfolios. So with that, today we're going to start talking about what happens after you've finished your portfolio. So after you've done everything, after all the allocations have been completed, and now we're looking backwards and we're looking at all this work that we've done, and we want to make sure that it's still pushing us in the right direction. Because one thing that is important to understand is when you begin, you might have a certain goal, you might have a certain objective, you might have a certain risk tolerance, and you might build a plan and a portfolio that is perfect for that. But 10 years down the line, 20 years down the line, maybe even just a few years or a few months, something could change or something about you can change, and it's important to be aware of those things and see if they are worth making a change to your plan and portfolio. So phase 3, which is the final phase of how we do our business and how we recommend you do yours, consists of 3 key categories. First being portfolio monitoring, which is exactly what it sounds like. It's looking back over your portfolio, looking at your risk tolerance, looking at your objectives, looking at how it fits into your overall picture. So also seeing how it weighs against possibly your real estate, how it weighs against pension plans, how it fits into that overall picture, and see if it's still matching what we're looking for it to do. There's also estate planning maintenance. So while you may have written the perfect trust 10 years ago, again, you might have a relationship that changed a little bit, and maybe you're not too keen on a certain beneficiary anymore. Maybe you need to make a change. Maybe that's something to do with an insurance policy. Maybe you have a spouse that passed and there are things that need to be changed in order for them to continue serving you as you move forward. And then there's tax efficiency management. We don't want to be stuck with huge tax bills every single year. Sometimes it's unavoidable, especially if you're generating income from a lot of your investments. We're going to have to pay taxes on income. We can't get away from Uncle Sam. But there are things that we can do to possibly mitigate some of the tax consequences, or at least budget them in a way that does not surprise you. So we can plan for it and create a strategy that you are able to fulfill without running into certain roadblocks or just being surprised with a tax bill that you didn't expect. So it's something that might fit into there is our conversation of mutual funds versus ETFs. Because if I'm holding a growth mutual fund and it's doing really well, but it has a lot of turnover, if that mutual fund is buying and selling all the time and they're generating tons of capital gains, I'm not receiving any dividends, I'm not receiving anything, but I sure am receiving one big tax bill. So that is something that I would want to be planning for. If I have that in a trust account and it just keeps getting distributed year over year, it is a net positive for me. I pay the taxes and my asset grows, but it might be a cash flow impact that I'm just not ready for or I'm not planned for. So just being able to at least look forward and be ready for what's coming is really important.
You're not receiving the dividends because you're reinvesting.
Well, I'm talking about a growth fund.
Okay, but if it's moving money over, if they distributed capital gains and then you reinvest it, you pay the tax and you got more shares, but you didn't see it in your your
Correct,
account.
but that would be a capital gains distribution,
Yeah,
not
it's kinda
a,
like
not a
phantom
dividend
income,
distribution.
right?
Right.
It's reinvested dividends, you got it, but now you gotta pay tax on something you didn't see go to your bank.
Yeah, so another example of that might be something like a zero coupon bond.
But
Yeah.
where,
still an increase in your asset, though.
yeah, it will still be a net
Yeah,
increase in the
after
asset.
tax.
So it's all good, it's just you have to be able to see how that's going to impact your cash flow. Yeah.
When you're doing that, when you're reinvesting, are you being taxed along the way?
Yeah, the distribution on the capital gains dividend is taxable.
So if they're reinvesting and buying stock, you're being taxed on that buy.
That's
Yep.
the phantom income, correct, yeah.
Yeah, because it's like you put $10,000 in. If they distribute $250 of capital gains, they're just going to roll that back in, and your basis is going to increase by that $250. But that's what you're going to pay taxes on. So even if the cash doesn't like come out, it's still as if it got paid to you and then you bought it.
But then when you finally take the money out, you have more money to take out.
Yeah, so your basis will increase because basically you're paying the taxes for that almost in advance. So like versus if I'm holding an ETF, all of that comes due at the end when I'm up 60%. Or if I'm in a mutual fund, if I've been paying taxes along the way, I might sell when there's only a 15% capital gain because I've pushed up my position with all those distributions.
He has opinions on where to use the fund and where to use the ETF if you have that ability.
Yeah, and like I was going to mention, another example could be that zero coupon bond, because if you are receiving phantom interest, like we were mentioning, that will also be taxable to you. So if you have a zero coupon bond and it's going to mature at $20,000 and you bought it for 15, because that's how a zero coupon bond works, is instead of getting an interest payment, you're buying it at a discount which is equivalent to the interest over time. So that interest actually has to be taxed along the way. It might seem like it would make sense that you buy it at 15, you get 20 back, and then that you pay capital gains, but how it actually works is something called imputed interest. So you have to be able to calculate and put on your tax return the interest that you would have received in order for that difference to be made up along the way.
And the zero coupon bond, the reason that you're having to pay on that imputed interest that you're actually not receiving yet, instead of a discounted T-bill, is that brokerage companies create zero coupon bonds, and they actually bring the interest in and they keep it for you. And when you buy it at a discount, it grows the value, but because they actually get interest, you got to pay tax on it. Whereas if it's a T-bill, you buy it at a discount, you don't really get the interest until it matures or you sell it.
Right.
But it's a contrived type
So
calculation.
if you buy a T-bill through a brokerage firm, they're taking that interest.
No, not the T-bill. They'll buy it at a discount for you, and it'll mature at full value.
Right.
But zero coupons that are corporate, or even maybe T-bills, they are contriving it and not giving you any interest, but it matures at full value, and they're taking the money, therefore you pay the taxes.
Yeah, so there is actually a little bit of a difference there. There are zero coupon bonds, and then there are also what are called stripped bonds, where you take a bond and you break it apart. So you'll take the principal value and you'll take the interest and you'll break them. And then if you sell the principal at the discount to the customer, like the brokerage firm would, but they retain the rights to earn the interest. So they will continue to earn the interest because that's the piece of the bond they own. And now you're buying a discounted bond.
But you have to pay the tax on your imputed growth?
Yeah,
Okay.
so you're basically just paying imputed interest along the way of what you would have had to earn in order for that difference to be made up.
Who sells the only true zero coupons, the discounted bonds? Treasury or do corporates?
I think it would just be treasuries. Yeah. Yeah.
And so you don't pay tax until it matures or you sell it, right? But on the ones that are contrived,
the strip
and
bonds.
they strip them
Yeah.
out, then that's kind of what I said, but your answer is more advanced.
Yeah, it's just a more particular thing.
Okay.
But yeah, generally for the most part, when we're looking at zero coupon bonds, we're looking at T-bills anyway, because I mean, for the most part, if we're looking at corporate bonds and stuff like that, we're looking at mutual funds and ETFs. We want to be diversified or having a fund manager work on it for us. So diving into portfolio monitoring, basically the things that you want to be concerned about is the portfolio continuing to serve our goals and objectives, our cash needs, and our risk tolerance. And those are like the three things that you just want to make sure it's always doing. Of course, having it be low expense is good. Of course, having it be earning more than you're risking, all that's great, and optimizing is fantastic. But if you're perfectly optimized and it's not doing any of this, it's a useless portfolio. So we want to make sure that all of these things are in check. So our primary focus is going to be on the overall portfolio allocations. So where is our money in a broad sense, types of assets and their functions, what is each allocation supposed to be doing, why do we have it, and investment efficiency. So again, that's those things like risk to reward, Sharpe ratio, beta, alpha, expense ratio, all those fancy things. Is kind of like, it's almost secondary to these other two things, while it's still really important, and it's what we put our focus on as professionals in terms of building the portfolios, because all of this is kind of second nature to us. So we put a lot of our focus into the efficiency portion. But for a DIY investor, if you don't have all of the knowledge, if you don't have all of the experience, you can lack some efficiency as long as your allocations and your types of assets are still performing the functions that they need to perform. It's okay to own an expensive fund. It's okay to own individual bonds. It's okay to do these different things, but just make sure they're doing what you want them to do. That's really the most important thing. So if we look at a couple examples, what we're basically going to do is expand on some of the things that we talked about before. We talked about some different investor profiles, what their risk tolerance and objectives might be, and if they were on or off with their allocations. So what we're going to talk about today is some examples of that changing later on. So firstly, we've got an investor that's invested in exclusively growth stocks, and up until this point has seen massive returns year over year. Think somebody who holds NASDAQ, S&P, lots of growth funds, and just we've been seeing a lot of time. They've been in it for decades, so they've been able to see the average numbers push their investments upwards. And the investor has zero bonds or bond funds and earns minimal yield. They're not even owning value securities. They're not getting dividends. They're not getting interest. It's just growth. So we're going to assume that these distributions are going to fund retirement and that the present value of the account is sufficient. Basically what we're saying is they have enough money to fund all of their distributions. It's not a concern of whether they need it to grow anymore. So as the investor starts to near retirement, as we're getting 5 years away, maybe 10 years away, depending on how conservative you want to be, what are the challenges they can face if their allocation doesn't change from now? If they stay totally in growth funds, growth stocks, tech funds, what could be a potential problem? Anybody got any ideas? Sure.
The tech could actually get old and just die.
Sure could. When you're in these high-risk positions, it's high risk. I mean, it's kind of, when you have these high growth positions, these tech, which is super volatile, especially lately, and you know, back in 2000 was also an interesting time for technology. So these things that get really inflated values, while they can be a really good kickstart to the growth of your portfolio, while it can push you in the right direction, the risk you face these as we get near the end is we don't have anything stable to fund the distributions. Because now, even if you have seen 20 stock market and you've been able to take advantage of the average numbers, you've been able to take advantage of the year over year annualized returns, you still have the same individual year risk. You still have that super high risk, that really high standard deviation, that really high beta that still could take your portfolio down by 20, 30, 40, 50%. You still are at massive risk. And if you are at the present value that you need to pay out your retirement distributions, you shouldn't be needing to risk it anymore because there's no extra growth that needs to happen. Unless you're trying to fund something else, if you have the money you need to fund your goals, is it better for you, and this is also can be a personal question, is it going to be better for you to take risk on to maybe double it by the end of the time frame, or maybe have half of what you need? So it kind of really depends on what your goals are. So again, as we reach retirement, those volatile investments, like you mentioned, the tech funds, those could be things that drop really low. All the distributions in the portfolio would require a sale of assets. And that sale of assets would come from the growth funds. which are high risk. So you could be, at the last year, you could have had one heck of a run, 20, 30% year over year for decades, and you've just made millions of dollars. And tomorrow, we see another 2000. We see another 2008. We see another COVID crash. Whatever it is, and your portfolio tanks by 30% within a month. And now suddenly we reach distribution age, and yeah, we don't have to take out quite as much with required minimum distributions, but we also now have a much lower percentage chance that that recovery is going to come back and push us to the same level to be able to distribute. So there's substantial risk that the portfolio could see a large decline in value just before distributions. And that's why we stress the stages, that's why we stress the time frames so much, is because it's really important to be ready that if that happens, you are still able to fund. You are still able to distribute what you need, and you are still able to continue with your plan. So how would these concerns change the investor's goals and objectives? And remember, goals and objectives were referring to things like current income, growth in income, growth, speculation. So what might we be looking at if we're coming up on retirement? All growth probably has a goal and objective of maximum growth. Where do we think we would start to land as we change? Oh, not quite. So where do we think we would be moving to? Out of maximum growth, aggressive, like that sort of area. Yeah, we would be moving, we would start lowering our risk. We'd start looking for possibly some more current income. We'd want some more stability. So this investor would likely shift their goals to preserving capital and generating income from their grown assets. Because at this point, if they already have enough money, generating yield is just going to be some extra icing on the cake. If we already can distribute everything, if we could just move it all to a money market fund and just pull out what we need every year, that's totally fine. You could miss out on some inflation protection, but if you've got the money, you've got the money. So this investor would likely be advised to adjust their allocations over time to suit the new goals and objectives. So likely this would be something we want to anticipate. We don't want to be coming up on distribution date and now suddenly we're changing all the allocations, because that same risk applies. So we might be looking 5 years in advance. We might be looking 10 years in advance. It really just kind of depends on what the overall situation is. So we might be looking, okay, now we're coming up, it's maybe 7 or 8 years until they finally are going to start retiring. We're again still 100% in those equities and those growth. Now we're starting to peel off some of the most volatile positions and we're pushing them off into cash, into bonds, into maybe just more conservative indexes in the first place. So we just want to bring that overall risk profile down so that the percentage chance that we're going to lose the majority of our portfolio really goes away for the most part. And we're able to start pulling it back down to something more reasonable that'll suit the new goals and objectives. So what kind of securities are we going to consider for the new allocations? We're selling out of growth stocks. Now we want to start buying some new stuff. But what do we want to buy? Well, we're probably going to be buying dividend-paying or value equities. That's one thing that you can do if you don't want to just completely go risk off, but you do want to start shifting in the right direction, is if you have a lot of growth, you can start replacing it with value, you can start replacing it with dividend funds, you can start looking at government debt as well, you can look at investment grade corporate debt, cash and cash equivalents, and again, all of this is going to be very particular to where you are in your time frame, to where you are in your goals and objectives and your risk tolerance. So if you want to, if maybe you're starting to have a little bit of a freak out because you're going, oh, it's about 3 years till I have to distribute and I'm up like 300% on all these investments and I need to get to safety net territory. You can just start throwing some cash in some money market securities and worry about buying the rest later. So as we move forward, oh, yep.
Can you tell us the difference between what is equity? Equity is stock. A fund that's value, what it holds versus a fund that's growth?
Sure. So this is something we covered a little bit in phase 2 before. I can go over it again. So when we're looking for growth versus value, growth is generally looking for a company that is not generating current earnings. They're not maybe They might not even be profitable right now, but we're looking that they're going to be taking market share from their competitors in the future. So that's going to lead to capital appreciation of their stock value. It's going to lead to people being more interested in purchasing their stock and watching it rise. And maybe they're expecting dividends in the future. That was kind of like the old definition of growth, was that you're expecting future dividends once they finally have captured their market, once they finally have reached profitability and they become a blue chip stock and all that fun stuff. But nowadays, we see companies that just seem to never really turn a profit ever, except for their CEOs, who get like $130 million salaries, and then the shareholders get nothing. But that's a conversation for another day. But something like value, generally using more fundamental analysis, we're looking at the ratios of financial metrics, things like price to earnings. So we're looking at the relationship of the value of the stock versus how much of the company's earnings can be attributed to each share. That's a very common ratio that people use. Different things like price to book and a lot of these other things that, frankly, I have not studied well enough to explain. But there's a lot of these fundamental things that you can use to sort of give you an idea of how much am I paying for the income that's coming out of this stock. So one thing that you would notice on a value stock is you might have one that's a little bit more expensive and you're getting 1 to 3% a year in dividend distributions, but you might have a much more relatively cheap stock that's paying out 6 to 7% in distributions. It could be the same dollar amount of dividends, but it's just because the price difference in the stocks, you're paying more for getting the same amount of money over here versus over here, and that could be for a multitude of reasons. It could be just due to the popularity of the stock. It could be what the future looks like for that company. The cheaper company might, yes, be very stable, but not be looking for very much expansion in the future, versus the more expensive dividend-paying security might be looking like they're going to take more market share. So there might be more earnings to come in the future that you're paying kind of in advance for. So knowing all of this, when we're reaching that retirement area, what do we think is going to be the investor's new risk tolerance? Now I've got the list of all of our risk tolerances here. Where do we think they're probably going to land? Remember, this is that person with lots of equities, lots of growth. We're getting right up until retirement and we're getting ready to shift over and start distributing assets. Where do we think roughly we would land? There's no, yeah. You'd be exactly right. Anywhere from moderate down is pretty much where we would end up being. So it kind of depends. If you have way more than enough assets, we could probably stay at moderate. There might be some extra money that we could let grow while the rest of it pays for distributions with yield, dividends, all these different things. If you have just about the right amount of money, but you still want it to grow over time and outpace inflation, you might stay moderately conservative. Or maybe if you just have enough, you have just enough to fund all the distributions, you don't want to worry about whether it's going to fluctuate too much over the next couple of years, you might stay conservative. You might stay in a lot of money market, a lot of short-term bonds, and let your stage 3 or long-term be your longer-term bonds that have time to recover. Now obviously, there is the risk with long-term bonds that when they crash, they take a long time to come back. So it kind of is going to depend on the context of the economy at the time. So right now is one of the rare times that we've even discussed in office of moving into longer term securities, mostly because we see the interest rates kind of starting to flatten out. But those conversations seem to change every day. So they might start going right back up, yeah.
Well, do you take into consideration, say, what the situation is now with an inverted curve in the short term, giving more than the long term? Do you take that into consideration?
So it is something that we'll look at a little bit, but it's not really something we're basing all of our investments on. Again, even with these longer term bonds, when we consider putting them in, it's such small little portions of our total allocations, because it's not like we're going to start rotating all of our short-term treasuries into long-term corporates and things. But yeah, that's kind of one of those things where it's interesting to look at, but it's difficult to use a lot of these metrics to look forward. Like I notice a lot of people will say, look, the yield curve is inverted, and then they'll have some sort of investment strategy, and it just doesn't do that at all. It
it's
just
a wonderful time for short-term money.
Yeah.
Yeah, but we need to get long-term rates higher than lower. So you'll lend money to people for mortgages and they can buy houses, and the economy grows by having the attraction for you to lend your money long term. But right now the attraction is I'm not going to give it up for more than 6 months.
Well, I just got, actually, probably in that scenario, I just got my first 1-year piece of paper, because it just went over 5.
Yeah, and if you can lock it in for a year at 5, that might turn out to be really good. Then again, the inflation numbers came out to be higher yesterday, and interest rates ain't going anywhere, folks. They can't drop them this year. We bought a few intermediate term treasury funds, and I'm down 1%. It's like, what? I thought rates were going to come flatten or go down. And now they're saying that inflation's here to stay for a while. But sooner or later, the long-term yields might be lower. Or as we point out, if you only had $1 amount, you had to lock in your yields, then you're going to have to go long-term and don't worry about the resale value.
Yeah, and one of the other things that is kind of nice about having a diversified intermediate term and longer term bond fund, especially when it's paying out dividends, is you're able to buy back some of the shares at a cheaper price. So as the value of the bonds fall, you can start to sort of average down with your dividends or possibly some other cash that you have. Because obviously, when rates start to skyrocket, long-term bond values really, really drop. And if you're still getting those interest payments, you can put them in.
If you bought treasuries at 12%, and then rates dropped in half. Or recently, 2 years ago, Vanguard's extended term treasuries dropped 40%. Now, we would love to jump in right after that, but they can fall further. So it's all about the financial planning concept. That's what makes you successful. What's right for you isn't right for somebody else.
Yeah, absolutely. So you should do more. Basic allocations do not always protect us when markets turn sour. It's not always just going to be equities and bonds are going to save you. A 60-40 is not always going to be perfect. I think it was a couple years ago when they started saying the 60-40 was completely dead, and now they're starting to walk that back because now bonds are okay.
Why did they say that?
Because bonds paid nothing.
Nothing. And so they say go buy real estate, gold, something else. Alternative investments came out. And some of them tanked, and some of them didn't.
Yeah.
It's more dangerous, so a lot more risky than bonds. Now bonds are back, right? Now, because our portfolios 2 years ago were down 2 to 3, 4%, but other ones were down 20+% because we've been preaching short term, short term, short term. One of these days we'll or just to get some yield back, because the short term CDs and bonds, one of these days, if rates do fall, you will wish you had the 1-year CD or bond, right? The opposite could be true, so we don't want to have, what's that term? Not fear of missing out, but recency bias.
Yeah.
You've always got to think at least the opposite and maybe not get drawn into rates are going to do nothing but what? Go up, go down, go up.
Who knows?
People think they're going to go up. Maybe they'll turn around and go down. We don't know.
Yeah, and that's again why you just need to stay diversified and kind of just gauge your risk. And that's why we like to look at duration a lot. And that's why we like to look at these different things where if you have a super long duration, then you're just simply, your risk is higher. So regardless of whether you think rates are going to go up or down, your risk is just higher, period. There is no changing that if your duration is really long, if the average effective maturity of the bonds of your portfolio is really high, no matter what, if you're wrong and rates start to go up, your bonds will fall, period. There is no fighting that. Now, the higher your yield is on your bonds, that can protect you a little bit, but at the same time, it's not going to do all the work. So you have to be able to get a little bit more specific with your allocations in order to protect yourself. And that's when, you have your basic, your equities and your bonds, and that's great, but it's also important to understand what the area that you're in is, what kind of sentiments there are, and at least not try to predict, but at least insulate yourself from different types of risk that might be a common conversation piece right now. That might be something that we're anticipating, that if interest rates are to make a change, do we want to have a ton of risk on in that area? If you do, that's fine. But if you don't, and you don't want to see your bonds fly up and down, shorten your duration. And that's why it's really important to get a little bit more specific with your allocations and make sure that you're protected from those very specific types of risk. So the hands-on investor should be doing a lot, like a lot of work. you should be your own professional, really. I mean, you are your own fiduciary. You are the person that's looking out for yourself. So you should be doing as much work for yourself as you would for somebody else. Like, you should be doing the kind of work that you would expect us to do for you. And if you're not, then you're missing out on a lot. So on a daily basis, it's important to just kind of be aware of what's going on. It's important to pay attention to things that are happening in the economy, things that are happening just generally in the world. And the reason for this is not necessarily that you're going to make the next best play. You're not going to be Michael Burry in 2008 and make hundreds of millions or billions of dollars off of a real estate crash. But it will, again, like we just talked about, it will influence you to look to what specific risks you have, to what you're concentrated in. Because if you're really concentrated in technology, and you've seen that technology has done one of the biggest runs it's done in forever, you might want to lower your allocation in technology a little bit, be in a couple other sectors. If oil has done nothing but run higher for the last few years, again, if you have a lot of energy holdings, that might be something that you want to adjust. It's just simply knowing what kind of specific risks am I exposed to, and are there current events happening that could drive that risk up and down. So also, you should be paying attention to changes in tax code or other laws and regulations that might affect your portfolio, because you never know, especially with something like estate planning. We know that the 13 million is going to sunset to like 6, and if you have over $6 million, you might have just 8 million when you had absolutely no concern of having estate taxes. Now suddenly you have $2 million that's going to be subject. And now you got to figure out a way to deal with that. You got to figure out a way to either gift it over lifetime or figure out a way to just get it separated. But those are important things that you'll have to be aware of, that if those things change, you're going to have to take a look at your portfolio, take a look at your assets, and make sure that you're not losing any benefits that were crucial to your success. If tomorrow municipal bonds started being taxable and that was your whole portfolio, you're going to have one heck of a time come April 15th. So it's just important to be aware of those things. It's not like the whole game is going to change overnight, but it could. So it's good to just be aware.
The sunset?
Yeah.
Taxes are going to sunset, so they'll go back to where they were. Is it like 2 years?
2025.
Yeah, so the SALT tax goes away unless they redo it. Your taxes go back up, right? And then the estate tax drops down to about 6 million or so.
Yeah.
Five plus inflation.
Yeah, 5 indexed, which I think was like 6 or 6.5. Yeah.
But those are also political issues now. Oh my gosh, we can't let you lose this. Vote for me and I'll make sure I extend it. So that's going to be something that.
Yeah, but the tax, what we go back to, I think the steps are very different. Because the taxes back then is 24, 28. Yeah. So you have a lot more to give for those taxes. But right now we have 22, 24, and then goes up to 30 something.
Right.
So sometimes it might hurt us at this tax rate than going back to the old way.
Possibly.
Right. Yeah. So again, if you are suddenly now at a position where it's actually better for you, you might be able to take more advantage of other things, or take less advantage of certain tax efficient investments that maybe you just don't require anymore, and you can get back to the equivalent value or yield or whatever it is that your plan had. You just need to be aware that you might be able to get some money back.
Yeah. Things can happen, as Nash pointed out on the first one. I don't know if the numbers are true. Did oil go up a lot today?
Did what?
Oil prices.
I think it did go up.
Yeah, this conflict is coming to a head, right now with these two countries. And I thought I heard somebody say that oil, went way up, but that's something you can't know ahead of time. But at least be aware of them, right?
Yeah, exactly, because it could push your allocations out of balance.
Or maybe this issue is coming, and maybe I'll move out before I find out it happened or it didn't.
Yeah, because you can always think that you're going to be able to predict the direction of a news event. And if you're right, you might make a ton of money. But if you're wrong, you might lose the same equivalent amount. So it's just kind of, am I willing to put my assets at that risk? Again, it just comes down to your goals, your objectives, and your risk tolerance, and making sure that you're in line with those things at every single moment, because those diversifiable risks, they can change in intensity. They are not always going to have the exact same effect Oil running higher is not always going to give you the same exact effect on your portfolio because it could be at a different intensity. It could be at a, like, just things could be different overnight. So it's important to be able to.
Did you plan this out for today? Because market's down 475 at 1,000 points from its high.
Yeah.
I'll look for oil and see whether or not that
Oil
was.
didn't back up as much as the market.
Okay.
Yeah, oil's been doing pretty well. Oil and precious metals also. Gold is just,
Gold,
Yeah.
it's gone.
We're actually
Buy
selling
at
so
Costco
fast.
now.
Yeah, that makes
that's
sense.
right. But you come out of there, your bags kind of break, don't they?
You use a pallet.
Okay.
Yeah, exactly.
Nobody will know what you have.
So yeah, all those things are really important, and just being able to see what the implications are going to be. That's another thing that also I feel like a lot of people don't put enough weight on, is being able to understand how does it actually affect me. Because you might think that there's all these conflicts, but they're so far removed. I'm in US large cap. Global events have a huge, huge impact on the US stock market and on bonds because we are interconnected with the entire world. We are one of the most interconnected countries, if not the most, maybe alongside China. But we are connected to everything that is out there. So it's important to understand how those different events could impact the volatility of your portfolio. And keeping an eye on the activities of the Fed is also very important. Keeping an eye on interest rates, monetary easing or tightening, understanding what it is they're doing to maybe push inflation back or to let it run. Because again, that's mostly going to be our bonds, but at the same time, if short-term interest rates get really, really high, it might be understandable that some investors want to pull out of equity markets. They want to pull out of energy markets. They want to pull out of precious metal markets and move into money market funds and short-term bonds. Because if you can already earn 5 to 7 to 8%, that's pretty close to a lot of balance funds. That's pretty close to a lot of full-on custom-built portfolios. If you're earning 5, 6, 7%, you might as well just stick it in a bond that you know is going to return your principal guaranteed, and it's going to pay you your interest, especially if something like a treasury bill. It's almost like it feels like a no-brainer to capitalize on that, especially if you're wary about equity markets.
Did
It's
that
just
happen in 2022?
something like that, yeah.
Rates went up, and then especially growth stocks went down.
Yeah.
That market was down like 38%.
Mm-hmm.
And then 2023, second half.
Yeah. So on a weekly basis, something that you might do is just monitor fund news updates and alerts, different things. You might be watching the funds that you have in your portfolio and monitoring their fund metrics, and using software like Morningstar really simplifies it. Because yes, you could go and find the prospectuses of all of your funds. You could go to their individual companies. You can do all of that. You can add all the numbers up and you can average it for your portfolio, or you can just use something like Morningstar and you can just import all your holdings and let it run the numbers for you. But the things that you'll want to be aware of on a weekly basis, maybe on a monthly basis if your allocations don't need to change too often, is just being aware of what is happening in there. You don't have to be making trades every week. You don't have to be changing things every week. But it's just important to understand kind of where we're at all times. Because again, like we mentioned, things can change really, really, really fast. Rates can go up really fast and bond holdings can crash. Equity markets can just spool down for a long time very quickly. I mean, again, today was a huge fall. If you were holding all NASDAQ today, that was not a fun day for you. And so it's just important to really just be aware of where you're at. So you just kind of always have this picture of what your portfolio looks like and how it's performing. Not that you need to be making changes, like I said. You don't really need to do anything, but you just need to be aware so that if you need to do something, you know you need to do it. And continue your education. I like to think that this class does a pretty good job of letting you know what to do, but at the same time, there are so many niche situations and there are so many different little tax breaks, estate planning hacks, and all these different things that I wouldn't even know where to begin with. And there's a lot out there, a lot of reputable sources that can give you some really good information. So one of the places that I use for a lot of the definitions in our presentations, but just source from there, is Investopedia. It's a pretty generic education platform to learn from, and I wouldn't necessarily look for advice from them, but it's a good place to learn the basics of the definitions of things like alpha and beta and standard deviation, and just those different sort of metrics and any of the terms that might have just gone over your head. Investopedia is a really good place to go and get some simple definitions and just be able to brush up on the language. It's really helpful for that. Morningstar has several different podcasts, actually. They have some longer term view podcasts, they have some shorter term, some more specific things, but they've got a bunch of podcasts that you can listen to, and they bring on a bunch of huge fund managers and people that work at banks and all sorts of different things, economists, and they get their opinions. Now, following any one economist probably is not going to enhance your returns by a whole lot, given their about 50-50 accuracy rating, but getting a general opinion of what people think about the current market conditions could help you, again, go back to your portfolio and look at what might be exposed to particular kinds of risk. Another place that I like to get a decent amount of news from is Bloomberg. Pretty helpful, and they've got live TV that streamed all day. They talk about Asian markets, European markets, US markets, all sorts of different stuff. And you can actually watch them for free on YouTube. So you don't even need to pay for anything, unless you want to read all their articles, because they'll lock them behind a paywall. But you can watch their live show on YouTube all the time, and it's pretty nice. There you go. And also, if you want to use Morningstar, I'm sure you might have noticed in some of our emails, we have some references to some library cards from some other states and in here that allow you to get a much cheaper subscription price. And that's a pretty fantastic thing, where you can just pay for the library card and you get Morningstar for free. And it's definitely cheaper than the monthly subscription, I'll tell you that. Oh, yes.
Kiplinger, is that another magazine?
Oh, yeah, I believe so.
Is that okay too?
Yeah.
Yeah, they're legitimate. Kiplinger used to be that old folded, typed out little newsletter that we got. They're very legitimate. They just have old style, so it makes us feel comfortable that it's, the old news feel.
They have different things, several products. They
Exactly.
have a tax
one.
newsletter.
Yeah. It's nice because they give you the most recent information, and like old school, you just opened it up, folded it out, read it, and you got right to the point, rather than having to go on the computer and find it. They do that also, but Kiplinger's good.
I learned about it.
Yeah, they're very good.
Yeah, so having a lot of different sources of information kind of, again, it's like diversifying. It's like diversifying your knowledge base and not putting too much stock on any one person's opinion, not even ours. So like, we could be wrong about certain things. And if you're able to go and verify information that we give you, or you're able to counter it with something better or something that suits your needs better than what I have told you, that's fantastic. It's best for you to be able to go out there and learn all of these things and be able to be very aware, even if you're not doing it, at least being aware that your advisor's putting in as much work as you should be paying them for. So on a more monthly basis, it's time to go shopping. Time to go looking at different funds to see if anything is better than what you have. Again, you don't need to be forcing trades. Like, if you have the best allocations possible, you don't need to be changing anything. As long as they're meeting your needs, they're fine. But it's possible that you could still be just searching around. Maybe you've been holding an SPY for the longest time, and like me, you finally just discovered SPLG, which is the same thing, but cheaper, from the same company, I might add. So you might discover new things like we do all the time just by looking through your screeners. Using Morningstar has really, really powerful fund screeners where you can put in what kind of category you want it to be, how well rated you want it to be, what the risk level is like, what the expense ratio is like, what's their beta, what's their Sharpe ratio, what's the standard. You can sort by all these different metrics, everything that we've talked about, and way more, stuff that I have never even heard of. They have screeners and sorting and lists for all of it. And they're also super helpful for if you are an ESG-focused investor, because you can search by all those things and search by how sustainable they are on an ESG basis. And if you want your whole portfolio to be super socially responsible, that's doable. Granted, you'll probably pay more of a fee for it, and some performance might not be as great, but there are a lot of, say, S&P 500 ESG funds and other things sort of like that that are similar to things that we use on a common basis, but might fit your own moral compass a little bit better. So stuff that that meets your objectives better offers historically more favorable risk-adjusted returns. So again, using those things like Sharpe ratio and alpha, while they're not an end-all be-all measurement of performance and suitability, if you can get something that is really similar but ekes out a little bit more extra return year over year on a consistent basis, then you're going to want to swap that for what you have. So stuff like 10-year measurements of Sharpe ratio, 10-year measurements of alpha, that's what I'd be looking at. 3 and 1 year is just too short of a time frame for me, because so much can happen where if you just have a bull run for 3 years, the alpha looks amazing because you've done nothing but generate money and you haven't lost anything. But at the same time, that could have just been timing and luck. So you never really know. So super long-term metrics, if you're going to be looking at risk-adjusted returns, are important. This is also a great opportunity to bring overall portfolio cost down. So that's something that we like to do all the time, is if we're looking around, especially if I'm looking on an account that maybe hasn't had a trade in a while and it just is time to do another reevaluation, we'll look through everything, see if there's any funds that are particularly expensive. And if there are, I would want to look at what it's doing. Is it a bond fund? If it is, how much yield are we getting? What's the duration on it? And how expensive is it? Because can I find something very similar, same credit ratings, same or better yield, same standard deviation, same duration, but just 5 or 10 basis points cheaper? Because if I can find that, I would rather take those 10 basis points back and add that to my overall returns over the long term. Because realistically, if you're getting the same thing but you're paying 10 basis points, that's 10 basis points a year, every single year, in perpetuity that you're going to lose just for somebody to do the same job that somebody over here is doing for cheaper. Loss positions are really great candidates for replacement, both in qualified and non-qualified accounts, but non-qualified makes it even sweeter because you get a little bit of a tax break. But loss positions are great because one of the great things that you can do is if, for example, say I'm sitting in QQQ, right? I've been holding that for a long time. I believe it's 20 basis points to hold. And let's say it's just been down 30, 40, 50%. And we're sitting down at this bottom, and I don't want to change allocations. I don't want to be in something different. But I just learned about another mutual fund from the same company, same situation as earlier, QQQM, and I realized they charge 5 basis points less. That's a really easy swap for me to make. Sell the QQQ, buy the QQQM. Now, if you're in a non-taxable account, make sure that if they're that similar, you don't do the transaction within 30 days or else you won't count the loss. So wash sale.
Taxable account.
Yeah, non-qualified.
Oh, non-qualified. Okay.
Yeah. So that's just something to be aware of. The wash sale rule can apply in some of those situations. But if we're just looking at an IRA, that doesn't really matter anyway. But if I want to move from something that's a little bit more expensive to something that's a little bit cheaper and it's the same, it's a no-brainer. I instantly improve my portfolio and don't change a thing. So another thing you can look at is if old mutual funds have transitioned into new ETFs, and if that's what you want. Maybe it is, maybe it isn't. There are a lot of mutual funds that maybe have converted or are looking at that, or at least they've released a new product that matches that mutual fund in an ETF format. Now, if that's something you want the tax efficiency of an ETF, you want the day-to-day trading, you want exactly what it has, that might be a great swap for you. But if you're too much of capital gains for it to be worth it, maybe you don't. Maybe you don't sell that and move over right away. So it's just a good time to shop around, see what's available, see if there are things that you can replace for better metrics overall. But it's not really something that you want to be changing everything on a monthly basis. Yeah?
If you're in a mutual fund that they're doing reinvesting, you can actually, if it backs up, you can open it up and start taking losses and gain into transactions. If you do individuals, you can actually save quite a bit of money.
Interesting. Okay. Yeah, that would be something great to look at. So on a quarterly basis, something we're starting to get a little bit further in between, but now we really want to be looking at our portfolio metrics and our allocations, because a lot of things can change quarter over quarter, much less year over year. Things can change a lot. But it's important to just really be looking and make sure that all of these objectives and risk tolerance, portfolio income, risk adjuster, all of that stuff, this would be the time to actually start making those trades. So if maybe through the month you found 3 or 4 mutual funds or ETFs that are cheaper, or they do something better, or you just want to get in on a quarterly basis, now might be the time to actually make those trades and start adjusting, make some adjustments to make sure everything fits your needs overall. Biannually, you probably want to look at overperforming funds or underperforming funds. So there can be a multitude of reasons for why something would do good versus why something would do bad. It could be just luck of the draw. You could just have gotten in at the right time and you made a ton of money. And maybe you just want to secure that and move it back into something that still fits your risk profile but isn't as concentrated, and you're not going to be giving up a whole lot of gains. So if I have a big growth fund, a big tech fund that just took off without me, and I went from a 60-40 to 70-30, but I want to go back to a 60-40, I could take that growth fund and I could stick it back over into my bonds. Or if I'm willing to stay a little bit more aggressive, I could take it out of the growth, I could put it into value, dividend, maybe something balanced in the middle, and just kind of massage around and take the losses when you need them, take the gains when you want, and just make sure that you stay overall allocated properly and you're not letting anything run too far away from you. Because whether that's good or bad, it changes the overall allocation of your portfolio. So stuff that runs, whether it's up or whether it's down, at least be aware of what that's doing to your portfolio and how it's changing, because it might be time to swap laterally, or it might be time to sell off some risk and buy some security. You never know. So it's important to really just watch those runners and detractors and be able to move them around. Now, annually, review yourself. Go back over what you need. Like, what are your objectives, risk tolerance, liquidity needs, and has any of that changed, or has anything else changed? I mean, some of the conversations that we had before, we talked about what might happen when you have sudden cash needs. We talked about what might happen if you have a windfall that you weren't expecting, an inheritance you weren't expecting. Maybe you're paying for education that you didn't know you were going to be paying for, or anything. It could be literally anything. But it's really important to go through these diagnostics again, to look at your cash flow, to look at your insurance documents, to look at your estate planning documents, to look over your tax planning, and really look at, is everything for me still the same, or am I starting to change? Because a lot of people will, I mean, I've mentioned this a few times, but a lot of people will think that it's kind of a set and forget scenario. But it's not, because you can change. I mean, literally, you could be just at a point in life where you have taken risks all years, you've done a lot to grow your portfolio, and you've made a whole lot of money over time, but maybe you've just gotten to the point where that stress just isn't worth it anymore. Maybe it's just time to start dialing back and just enjoy the fruits of the labor. And you could have no change in liquidity needs. You could have no change in objectives. You could have no change in cash flow. You could have no change in insurance needs, no change in estate planning needs, no change in tax planning. But if your risk tolerance and your emotional capability to see volatility in your portfolio changes drastically, that's going to be a pretty big effect on the whole plan, on the whole allocations, on everything. So as much as it doesn't feel like it's the most important thing, reviewing yourself and reviewing what you want and what you need for you is going to be the center of all of this, because all of this is built around that in the first place. All of this was for you. All of this was for your needs and your objectives and the things you wanted to do with your assets in life. So go through the diagnostics again. Every year, even if you want to only do it every 2 or 3 years, it's just important to know where you're at, to be able to really evaluate how you're doing today and how you're doing in a year from now and a year from now, so that if things start to change or needs start to show their heads, you're able to allocate for that and you are on it, you are anticipatory, and you're not lagging behind. Lagging behind your own needs is going to be one of the things that always puts you over that edge of not being close enough to fulfill all of your goals. So it's just something really important to keep in mind. So don't be scared of the change. If something about you or your needs changes, don't hesitate to act on it. Like I mentioned before, you are your advisor. You are your fiduciary. You are the person who is responsible for these dollars. You are the person who is responsible for the growth, for the income, for all the allocations. And if something changes, you shouldn't be hesitant to acknowledge it and be able to move forward with making the changes to your portfolio, to your plan, in order for it to bring you closer to success. Because some people might just not want to recognize what changes about their situation. They might not want to recognize that they need to take on more risk, but if they don't, the assets just won't grow. And if they don't grow to suit your needs and you can't fund it, well, when the last dollar comes out, there's going to be nothing left for us to do. So it's important to be able to acknowledge your changes and not hesitate on acting on any of these things. And be your own advisor, be your own fiduciary. Even if you're paying somebody else to do it, it's important to be able to be aware that they are acting in your best interest. You don't want to get taken advantage of out here, because all of these things are very complicated. It's very easy to get sold something that sounds amazing, like annuities and indexed life insurance, where it could be a decent enough product, but it could just be way more than you need. You could be paying ridiculous fees and commissions for stuff that you could have done pretty easily on your own. So let's take a look at a couple different real-world events that shifted our outlook on things. So there's a lot of times where almost everything felt like it changed, and we needed to adapt very quickly. So let's take a look at some of these different events. The big one, 2008, is a really good example of a lot of these different things that we talk about. So I'm sure you all know the story, but we'll go over it one more time. Famously, a lot of these big subprime lenders, people that would give loans to people with lower credit scores, lower incomes, and maybe no incomes at all, if you ever heard about a ninja loan, no income, no job application, they would just be giving loans to pretty much everybody. Like, you walk into the mortgage broker, you walked out with a loan, no question. Like, there was no getting denied. What would have been the point? The people who made the commissions on those, they were living their best life. Best believe it. After the dot-com bubble, the Fed lowered the federal funds rate from 6.5% all the way down to 1%. So that's the rate at which the banks are lending each other money. So when you bring that all the way down, the loans get much cheaper and cheaper because it's relative. They have less that they have to make up for when they're borrowing from each other. So they're able to, those rates come down and people are able to purchase with lower rates. So those house prices started going way up. Kind of similar to what we saw a few years ago before the rates started coming with us and then prices didn't go anywhere, which that'll be another one. But these low rates just started sending house prices skyward. So what happened was a lot of people, they would just see these house prices continue going up and up and up, and everybody would want to buy and get in. Now, on the back end of all of that, while people were purchasing more house than they could afford, getting qualified for loans that they could not realistically pay off, what happened was the Wall Street banks, the investment banks, they purchased these subprime loans, and when you hear the word subprime, it's horrible, really bad. High risk of default, not good. We're probably not getting our money back. So they were able to take all of these subprime loans and put them together in a pot, package them up, put a pretty bow on it, and call it a mortgage-backed security and collateralized debt obligation, which sounds wonderful. Collateralized debt obligation, that's great. I have a debt and there's a piece of collateral that is backing up that debt. Mortgage-backed securities were always seen as super safe because real estate was rock solid forever. But rates began to rise. Slowly but surely, they started going up. And home ownership, everybody had the home. Everybody bought a home. Every single person was getting qualified for those loans, and they were buying them. They were buying houses with adjustable rate mortgages, where right now you were sitting at the nice low rate, 1%, 2%, 3%, but whenever the adjustment period kicked in, you would adjust up to the market value, to the market interest rate, and you would start paying that on your loan. And a lot of people didn't understand what that meant. They didn't understand how that could change their mortgage payments, how that could change everything about their cash flow. So with those adjustable rate mortgages, and they started to go up and up and up. And because all of these people were already underqualified for their loans, they already were borrowing way more than they should have. They were buying houses because everybody was convinced that you buy a house, flip it in 2 years, and you make $250,000. I know a lot of people. I know a lot of kids that I went to school with whose parents fell victim to that. It was really, really common actually in our area. A lot of people built these houses and they remodeled. I can think of literal mansions on people that, like, they made good money, but they just bought these giant $1 million houses, put another $250,000 in remodels. They thought they were going to sell it for $2 million in a year. And then all the rates started going up. And their mortgages like doubled and tripled. Yes.
Wasn't also the time that people were borrowing against those houses and buying boats and cars and everything, and then
Oh yeah.
everything collapsed?
Yeah, because I mean everything, like just so much of our economy is built on debt, that when debt starts to go bad and defaults start to rise, that is a rippling effect on the rest of our economy, on the rest of our investments.
Remember, one of your friends had a big mansion type house. He had retired from a big company and he had all his retirement and everything. Bought this big house, he's gonna flip it. We go to the birthday party, they have like alligators and all these exotic animals and everything. But he ended up having to sell the house at a little bit of a loss and move away and get a job. So it's not what you do, it's how you do it.
We're actually coming to the same thing again. Right now, short-term money is 21%. Default rates on credit cards are going up rapidly.
And people are using them more, right, as a short-term solution.
Yeah, as cost of living goes higher and wages like barely move, even if they report that they increase, in a real world, it's not that, especially on entry level.
It's all common sense, because if you're going to buy a house, you can get a lower adjustable rate, but the risk is it goes up and you're in trouble. But if you've got enough money to pay it off and you don't want to use it, you do an adjustable rate, okay, force my hand, I'll pay it off. But you can't afford to do an adjustable rate if worst case scenario happens. And that's what the planning process is. Cash reserve, short-term, intermediate, long-term, just in case. And you do give up some gains because you can't put everything at risk. But adjustable rates, very dangerous, wouldn't do it unless you have enough money to pay it off.
Yeah, so what started to happen was as these defaults started going up, as the rates started getting really high, say you had a $1,500 mortgage and it jumps to $2,500, it jumps to $3,000, most people are not going to be able to sit through that. They can't just pay that. If my rent doubled tomorrow, I would have some problems. I would have some serious cash flow issues. So that's exactly what happened. People's mortgages doubled and tripled left and right. People who owned multiple houses also saw their mortgages double and triple. So if you had a few vacation homes and all of these were adjustable rate mortgages, and now suddenly loans are doubling and tripling, it's not just your primary residence that you're worried about. It could be a rental property, it could be a vacation home, and suddenly all these payments jump and you have no way to compensate for all that. Because I bet you the same people who you're either renting from or whatever, they're going to feel the effect of it too. So everybody's cash just gets completely destroyed. Borrowers were owing more on loans than their houses were worth, because as the interest rates rose and everybody had a house, there was nobody left to be buying these houses at high rates with high property values. So the property values decline when there's just huge supply, way more supply than was needed. And so the housing prices started to fall. And because people were just so willing to buy a house with the idea that they could flip it in a year, they didn't care. They'd pay $50,000 over asking, whatever. It didn't even matter. They just were going to buy it and they were going to sell it next year and they were going to flip it. So huge loan amounts on these houses. And then the value starts dropping under the loan. Now you've got a $400,000 loan on a $250,000 house, and you don't feel so smart anymore.
And now we're getting hit with what? Insurance premiums double. I have rentals that they doubled within a year. Doubled. Not just 10%. That's interesting.
Yeah. So the housing market just completely fell to its knees. It collapsed. It just absolutely was just falling. Over 25 subprime lenders went under. Over 25 large lenders that were giving out mortgages to these people just completely went bust. The United States' two largest home lenders, the two largest home lenders in the United States, period, Fannie Mae and Freddie Mac were both seized by the government because they weren't able to, they were going to go under also. And if you let the largest lenders go under, what happens to the people with those loans? We also saw the largest bankruptcy in all of U.S. history, which was Lehman Brothers.
At least we got a good movie out of it.
Yeah, exactly. Yeah, I do love The Big Short. It's one of my favorite movies. Also, Margin Call.
Yeah.
And so if we look at the cost of what happened here, and this, by the way, is just bailouts. This does not include people who lost money. This does not include your average everyday person who might have lost money. No, this is just bailouts at almost $1.5 trillion for these mortgage companies to not explode or implode. Bear Stearns' bailout was $30 billion. Fannie Mae and Freddie Mac was $187 billion. TARP was $440 billion. ARRA tax cuts and spending, another $831 billion. Almost $1.5 trillion of bailouts to fix the situation that still left people without jobs, without homes, without retirement plans, and just crushed. People who were all completely retired that had to go back to work because of what happened. So while we can't predict things like this, sure, there might be some signs, there might be some things that we can look out for. But it's just important to remember that when we're invested, we have exposure to risk. And we have to be able to understand that that we have to be willing to feel the worst case scenario and still be okay with how our assets are allocated. So if you were over allocated, if your whole portfolio was in mortgage-backed securities, man, that would not have been a fun few years for you. That would have been really bad. Default rates would have been super high. If you were in all of these super ridiculous products like the synthetic CDOs, a collateralized debt obligation that was made up of other collateralized debt obligations that was a bundle of horrible subprime loans, so you could bear, and all of those got AAA rated, by the way, for credit ratings. They all got rated because they were basically paying fees to the rating agencies to give them a better rating, or else they threatened to go next door to Moody's or whatever other rating agency. So it's basically bribes to make it look like they were higher credit quality than they were. And then they just start defaulting. And it becomes clear that it's not really a AAA bond, it's more like a single B or not even rated.
Back then we did Ginnie Mae government mortgage funds for reasons we couldn't think of. You just didn't know. I'm staying with the government. I don't know why, but Ginnie Mae's field, they just seem better, and then this is what happens.
Yeah. So the damage from over-allocation could have been absolutely lethal. I mean, like I mentioned, if you were in all mortgage-backed securities and you thought, I'm investing in real estate, it's a really solid market, I'm getting lots of yield, this is great, your entire portfolio could have been wiped out in a matter of years or even months. So there's a couple more recent events that we can talk about. Stuff like the supply chain problems. You remember those? Cost of products increased across the board. You remember what happened to eggs? That was ridiculous. Toilet paper just completely disappeared for like a month, and you just couldn't get it anywhere. It both affected companies' ability to produce goods, but then also some other conglomerates were able to just increase their profits like ridiculous because they could just raise prices. So again, it's one of those things where it's hard to predict exactly what the outcome is going to be, but it's something to manage your risk to. The pandemic, when COVID hit, it drove workers straight out of office buildings. Commercial real estate, warehouses did fine. Storage for e-commerce brands and online businesses did just fine, but retail and office space, they did not do so great because nobody was in them. The offices were empty.
They're still not doing great.
They're still not doing amazing because there's a lot of hybrid solutions and work from home jobs now. I mean, there's a lot of jobs like this, especially the customer service industry, where it just kind of makes sense, where you can just let your employees work from home, and a lot of people, like, they just have their setup at home that you don't even need a central office. You only need that for the management or the officers of the company, but you don't need to bring everybody in-house when everything can be done basically online now. I mean, you can basically run all of the phone calls through voice over internet, so you don't even need the actual telephone sitting next to you. You just do it through your computer. So a lot of those retail and office spaces just did absolutely horrible. Sat empty, still are to.
I heard this from the news that the state government workers now, they're forced to go back into the office.
Yeah,
2
yeah.
days a week.
2 days a week only?
They go and try 2 days a week, yeah.
Because the business surrounding the area
Well,
are losing their business.
But
Right.
that's true national-wise. When you don't have employees going to work in a building, every business running that building is suffering.
Yeah.
Franklin Templeton have 4 buildings, and they're only using 1 now, so they left all these buildings empty.
Oh my God.
Wow. Yeah, that's incredible. I mean,
It's a
yeah.
chain reaction.
Yeah, exactly. All these very specific things, they ripple outwards. I mean, if you just take the example of an office building, you've got restaurants around it, you've got all sorts of different things that people could do, shopping after work or going out. Like, if those people just aren't in that location anymore, especially if they commuted a little bit, if they're 30 minutes away, why are they even going to be there? They're not going to. They're going to be back home. And if cost of living also just keeps increasing, they don't even have the money to spend anyway. So all of these things, chain reaction, ripple effect, it just spreads out into every other area. So it's really important that you understand that these different individual things can cause a lot of ripple effect risk in other places of your portfolio, of your planning, and just be aware of those.
And they can happen so much faster than you can plan for. That's why we are diversified.
Mhm.
We give up some upside just for the contingencies. And frequently it's something we didn't even dream of.
Exactly. So interest rates, I mean, it's something we talk about pretty much every time we do a class. We talk about interest rates in some form or another. But the continuing raising of interest rates just murdered long-term bonds. I mean, you mentioned earlier, they went down like 40% from the extended term bonds, like 30 years plus. The investors were just parking assets in cash. High yield savings accounts have become incredibly popular recently because you can get the same interest rate as you could in the short and intermediate term bonds. There just is no point in holding these assets that can move up and down when you could just open up a money market account, same thing anyway. And that's, again, like that inverted yield curve. It's like you don't even want to put the money in the other bonds because I can get the same amount of money anyway with less risk.
And you end up unintentionally protecting yourself with a short-term bond fund, because if rates go down, that bond fund's duration really is what, 2-3 years. So you'll keep your yield for a little while, and then it'll start to fall as the bonds mature. But on the other side, when we bought short-term bond funds when rates went up, we dropped for a little while, but we regained that as the bonds matured.
Just have to be careful about getting called.
Yeah, okay. They can call, but they usually have limits, right? They have to pay you so much and they can't call for 10 years.
Well, you have to make sure that they're not callable, and when they are, you
Yeah.
know, when you get them.
On the individual bonds.
Yes.
Yeah, that's when something like it's important to understand, like if you have a callable bond, look, what's the discrepancy between your yield to maturity and your yield to call? Like it just, those things are going to be important. So it'll be important that you have at least a decent yield to call, but you will, for the most part, get compensated for that being taken away from you. So most of the time, there will be some sort of compensation for that written into the bond. And usually if it's callable, it'll be pretty obvious. They'll mention it in the name of the bond or something like that. So also, one of the other things that, this is a little bit anticipatory. It's not exactly happening yet, but you can see it in the budgets. We talk about Social Security funding. The future is not exactly super certain right now. I mean, I don't even know if it'll exist by the time I retire. Like, it might not even, we might have already forgotten it was real. It might be just a story for the kids around the fire. Like, it might not even exist. So it might be worth to plan for it not even being there in the first place. We are already going to see that benefits are going to drop by a quarter. So,
They'll give you coupons.
right, exactly. Yeah.
Here's your coupons.
Yeah. So, I mean, if you just look at the budgets, I remember the last time we did this class, we looked at some of the budgets year over year, and they were not bringing anywhere close to as much as they were paying out. They were not bringing it in through the taxes. And one thing that I've always kind of found really strange is why we cap the Social Security tax at, what is it, like 160?
168.
Yeah, 168. And we just stop charging Social Security after that point. which is wild to me because there's just all these people who are earning millions and millions of dollars. We could be funding Social Security with that. I bet you that would make up a huge portion of the difference if all we did was take off that cap.
Well,
Sure,
I'm
there's.
sure you know the tax cut will help things.
Yeah, right, exactly. So there are just all these different things, and again, it starts to become like this political issue, where these different people will put in different tax codes and different tax laws that might have some unintended consequences, like Social Security. Might not even be funded, might not even be around when my time comes. So I'm going to have to prepare and make sure that my assets cover everything. I'm not even going to think about Social Security, and if I happen to get it, fantastic. I'll be even better off. But even people who are close to retiring, even they might be a little concerned that Social Security might not be there forever. Like it may pay for a while, but then their benefits might drop. Maybe they'll drop again, and maybe they'll drop again, and maybe they'll just can the whole thing. You never really know, especially with our government. They can make a lot of very hasty decisions very quickly that have rippling consequences, and nobody seems to do the math for these things, which is really interesting. But again, all of these different things, it just goes to show that things can change really fast, things can change really severely, and it's important to be allocated properly for that. And that, again, that's why you mentioned, that's why we bias a little bit more conservative. Like we'll basically feel out what the client is, and we'll go one step down, because they're never thinking about worst case. They're usually thinking about standard, average, maybe all the way up to best case. But a lot of people, they're just not, like unless they're paranoid about it, a lot of people don't think about all those horrible things that happen and how much it rippled out into the rest of their investments. So it's really important for you to be aware of what that might do, the effects that it might have, and the things that you can do to fix up your portfolio and your plans to make sure that no matter what happens in the economy, unless everything just goes away, you should be all right. So make sure that everything that you're doing follows your objectives, follows your risk tolerance, follows your cash needs, all the things we've talked about time and time again. We've hammered in everything that I repeat 4, 5, 10 times. There's a reason for that, because they are the things that will hold you. They are the things that will carry you forward to the success of your plan.
Think about long-term care, whether you want to fund it yourself or if you have coverage, but just plan that if you're lucky enough to live long enough, you're going to need it. And at that point, it can be very costly. We have a client, how much do we pay out for her care?
Oh, I'm not sure.
We have to send her $16,000 a month so she can stay in her home with her live-in caretakers. So it's job security. I always joke with my clients, it's job security for us because you can't just go spend all your money. It could cost you, on the low end, maybe $60,000 to live in a residential care, but on average, 100 plus. But if you need medical assistance to get to the restroom, you're talking huge dollars, right? So obviously, it's too late to go buy the insurance. If you have it, keep it, and it's okay. It's your money. Spend it as you need assistance. But know that you're going to need a substantial amount, or the state's going to step in, and you're not going to love the facilities. So that's our big push for job security. We've got to keep investing your money.
Yeah. So with that brings us to the conclusion of our class today. Before we leave, do we have any questions or things you want to talk about?